Okay, let's do some practice exercises. It always feels better when you work some of these things, you know. We did this problem here. This is what we did with the T accounts and journal entries. Now these are just little practice things. The next category that you want to think in your head is about the difference between fixed versus variable cost, and then direct versus indirect cost. And direct, remember, can be traced to a unit. That's what you want to remember. Okay, traced to a unit of product. Okay, so let's look at this. So assembly wages, I put a little grid here and I put it next to it on this side. I just thought it'd be easier to see. So assembly wages, now a wage typically can be traced to a unit of product, okay? So we're going to say, I'm going to see, sorry, excuse me. We're going to say these are variable costs, and it would be direct or indirect. We're going to say it's direct because it can be traced to a unit. Now insurance expense. Does insurance expense vary with production or with the number of units produced? Okay, the answer is no. So this would be a fixed cost. And would it be directly traceable to a unit of product, or would it be indirect? We're going to say that it would not be traceable, so it would be indirect. Equipment depreciation. Is it fixed or variable? Okay, don't think about sum of the year's digits and double declining and all that stuff. Equipment depreciation is going to be a fixed cost. Okay, it doesn't vary with the number of units produced generally. Okay, and is it direct or indirect? It would not be direct because it's not traceable to a unit of product, so that would also be indirect. Those are both overheads, both of them, if that was on the factory. Manufacturing software costs, CAD/CAM, okay? That's computer-aided design and computer-aided manufacturing. This would be a fixed cost. It wouldn't be variable. It would be fixed. And direct or indirect, this would be an indirect cost. Also indirect, because it wouldn't be traceable to a unit. Uh-oh, this says raw materials trick. Ah, I know. If raw could include direct plus indirect. Okay, so if they said it was direct materials, then we would know it was variable. Okay, so we don't know here. It's going to be both. It's going to be it could be fixed and a variable cost. And for direct versus indirect, well, it's mostly, no, you know what? I'm going to say it's variable. Well, we're going to say it's mostly variable. But is it direct versus indirect? It could be both. Okay, what was I going to tell you? Now, if we were in class, I would have you do these without me looking at me doing it. So it would take more time, just so that you know that, and you'd be getting more out of it. So what you want to do with yourself, let's say that this didn't make any sense when I did it, just cover up your answer and do it yourself. Okay, some of the best ways to study is to take like a piece of paper and cover it up and do it again. You know, at least that will, then you'll make sure that you really understand it and you got whatever nuances were there. Okay. Then the other thing, we've got a little bit of cost, volume, profit here. We've got two formulas that fixed cost divided by the contribution margin per unit is break even in units, and fixed cost divided by the contribution margin ratio is break even sales dollars. Now what the ratio is, for what it's worth, if I had a selling price and a variable cost and a contribution margin, okay? So let's say I had a selling price of 100 and my variable cost is 60, so my contribution margin is 40. Sales would always be 100%, okay? Variable costs are 60%, okay, 60% of sales. Everything's expressed as a percent of sales, and the contribution margin is 40%. Okay? So, so the key is, what I'm trying to say here is that this piece right here, that is your CM ratio. And what that says is for every dollar of sales, we've got 40 cents of a contribution to cover our fixed costs. That's what that means, okay? But that's your contribution margin ratio. That is this number right here. Okay? So now we've got this local ice cream shop sells single scoop cones. And you know what you should do now? You should pause this and answer this yourself, and then I'll go over the solution with you, okay? For both of these problems. So single scoop cones for $2 each. Variable costs include the ice cream itself for 25% and the cone for 5 cents, so 30 cents a cone. The store manager plus 1 full-time and 2 part-time employees cost $3,500 a month in labor. Additional costs for rent, insurance come to $500 a month, so we've got $4,000 in fixed costs. What is the contribution margin per unit, okay, of a single scoop cone? Okay, so now you want to pause the tape, put a stop on it, and do this yourself. You're looking for the contribution margin per unit, and then I'll go over through it with you. Okay, so now I'm pretending that you just turned it back on again, okay? And what I wanted to show you with this is the way I set up all contribution margin programs, just because frequently, after you've been doing them for a while, they give you problems where you've got to find a number, and those are difficult, okay? So I would have a total column first, and then a per unit column, and then a percentage. Okay, so if you give me a few variables in here, I'll be able to solve the whole thing, and I'll know what all of my numbers are. So they said that we sold it for $2 per unit. Our variable cost was $30. That was 25 cents plus 5 cents. So our contribution margin is $1.70. So what's our ratio on that? The selling price would be 100%. What is that? Is that 60%? I think I just know that, right? Hold on one second. I got a little bit of email. Okay. So we've got 30 cents. 30 cents divided by $2. 15%. Okay. So this is 15%, which would mean that our contribution margin ratio must be 85%. Okay. And the question was, what's the CM ratio? And that's our answer right there, $1.70. Okay? Okay, so now let's look at the next one. This is Margot. How far are we? Okay. Margot has determined the contribution margin ratio of her product to be 40%. Selling price is $50, while its cost consists of 2 variable and 1 fixed cost. The sole fixed cost is selling and administration costs. Okay, so they don't have fixed manufacturing costs. The variable selling and admin cost is $2.50 per unit. Okay, variable selling. So we've got fixed and variable selling and administrative costs. What is the variable manufacturing cost per unit, and what is the gross margin of 1 unit of this product? And they said gross margin. Okay, they didn't say contribution margin. They said gross margin. But then they also say that there's no fixed manufacturing cost. Okay, so what's the gross margin percentage on this product? So again, you want to pause the presentation right here. Okay, and work on it yourself, and then come back for the solution. Okay, this problem could be a little bit tricky, just because they're using absorption costing with some variable costing words, okay? So this is one product, number one. It determined the contribution margin ratio of a product to be 40%, okay? And its selling price is 50. So that's a unit of product, while its costs consist of 2 variable costs and 1 fixed cost. The sole fixed cost is a selling and SG&A cost. The variable selling and admin cost is $2.50 per unit. Okay, now we don't know how many units we're selling. I'm just going to point that out. What is the variable manufacturing cost per unit? What's the gross margin of 1 unit of product if there is no fixed manufacturing cost? And what's the gross margin percentage? So this is what I've got on it. This is Margot. There's our selling price is 50, and that's 100%. And then the variable cost is 30. Where'd it go? the variable costs. Oh no, they tell us that the contribution margin ratio of the product is 40%. So if that's 40%, then this has to be 60%. Okay, 40% of 50. Oh, wait a minute. No, 60% of 50 is 30. Okay, and then 40% of 50, is this right? No, this would be 20, right? Oh, God. 40% of 50 would be 20. Wait, what didn't they give us the contribution? No, okay, they gave us 40%. So our contribution margin then would be 20. And then they tell us, the question is, what is the variable manufacturing cost per unit? So the variable manufacturing cost per unit would be that 30. So variable manufacturing cost is 20. And what is the gross margin of 1 unit of this product if there are no fixed manufacturing costs? Gross margin would also be 20. Okay, because there is no fixed manufacturing overhead. And the gross margin percentage for the product then, I'm going to say gross margin percentage is 40%. Okay, and in this case, the variable and absorption-based costing would be the same because there's no fixed manufacturing cost. Okay, if you don't get this, don't get excited about it, okay? We'll do a lot more work on this. It's kind of a tricky-ish problem, the way things are laid out for you, but it makes you think about it, so it's okay, you know? What else do we have here? A few multiple choice questions. I'm at 12 minutes, though. You're probably finished. Okay, manufacturing companies usually have 3 types of inventory. So we've got raw material, work in process, and finished goods, right? Which of the following are merchandising companies? So what would it be? It would be a retailer for sure, right? Wholesaler? I don't know. Do you think a wholesaler would necessarily be a merchandising company? I think so. They wouldn't be a manufacturer. So I'm going to put, I don't think they sell manufactured goods. So the answer then is really D, both retailers and wholesalers. And then Macy's, the department store chain, classifies its clothing held for resale as, what would it be? So you're supposed to be answering this now in class. That's the way this works. So the answer would be merchandise. Okay? Which of the following activities is not included in the value chain? And I just did a quick value chain here just to go back on this. We've got inbound logistics, that would be purchasing. Okay, then operations, where we do stuff and add value to it. Outbound is shipping and everything. Then we've got marketing and sales, and then finally service. So what we're trying to do is get rid of the non-value added activities here and make as much value added as possible. So the one that would not be ad design might be up here too. That which of the following activities is not included in the value chain would be reporting. Okay. Now let's look at this one. How many? There's several more here. I'll stop this here, and then I'll do the rest. Either that, or you can do these problems. Okay. So Lucky Cow, number 24. This is what we would do in class. Number 43 is Country Furniture. These aren't long problems, okay? You just have to go through the costs and figure out what are product costs, what are period costs, what's the total manufacturing overhead here. Okay, there are always questions like this on an exam, so it's good practice. Fit apparel, what's cost of goods sold? Okay, Pages sells books. The following information summarizes the company's operating expenses for the year. What's the goods available for sale? All right. And then we've got lawn furniture. You want to compute operating income. This is a good problem because it makes you do a full income statement. And yeah, it's always more difficult than you think or than you remember. So this is good practice, and you don't want to look at any notes when you do this. Okay. And then we've got another problem here, number 40. What else? That's about it. Oh, this is nice. So we've got, this is sort of a budget thing that we're going to do for 40. And then the last one is Anderson uses job costing system, record the following transactions. So this is a good problem right here. And the solutions are actually all right after these. So you want to record journal entries for all of these. Okay? And if you wanted, you could do some of it, yeah. You could do this in T accounts too. I probably would first. And then do the journal entries. And then here are the solutions. So let's see if we were right. Yeah, that's true. 3 types of, which of the following are merchandising companies? Yep, retailers and wholesalers. Macy's is merchandise inventory. Reporting is the one that isn't right. And then we go on to Lucky Cow, and all the solutions are here. So what I would have you do in class is to do all these problems, okay? And the journal entries are here too. So you do those, and then you're pretty well, this is what we would have done in class. Okay, you're pretty well covered. Okay,